Hello and welcome back to It's Contrarian, your channel for videos on the stock market. Today we have an in-focus topic which is residential real estate. We will go over these topics and I have a good one for you today. Airbnb propaganda and results, Marriott results, rent prices in New York and other major cities, travel statistics, credit card spendings, future outlook. We will start with Airbnb in the news. As soon as you search for Airbnb in YouTube, you end up in getting some of these videos in the top search results. Airbnb could face a potential mess in quarter 1 due to an oversupply of vacation rentals. Why you shouldn't make an Airbnb in 2023. Why I'll never rent on Airbnb. So with these titles, your brain will already conclude Airbnb is a bad business to start in 2023, or Airbnb will go bust very soon. Or maybe it's time for you to wait for the housing market crash and buy real estate. Let's hold on to that thought process and look into some of the actual results and numbers. Airbnb beats expectations when it announced the quarterly results in May 2023. If we ignore the COVID days, Airbnb growth in revenue is looking great. I thought with inflation, Airbnb prices were so huge that hardly people will book. But I got a pie on my face, and so if you're similar to me, yes, welcome to the reality. Wondering if I missed something, I checked the income statement. And here as well, the growth in income is great, especially with the average daily rates of Airbnb is only slightly less than that of a five-star hotel. The value for me is non-existent. However, a majority of consumers are still booking through Airbnb. I don't know who they are. I'll give you a comparison to Marriott and Hilton, and you will also wonder along with me. Otherwise, considering these results, it's a contrasting to see YouTube top search results pointing to Airbnb being a bad business. Is this a propaganda by the billionaires into convincing consumers and stock markets that the business is risky while Airbnb business is making huge profits and revenue growth on a yearly basis? Thereby, these billionaires are making more money both in Airbnb and in stock markets. Now, let's look at Marriott results. The average daily rate is in the range of $160 to $520, an average 10% increase compared to last year, while occupancy rate jumped from 14% average to 75% compared to the last year. So I immediately compared this to 2019 quarter 1 results. Average daily rate was in the range of $140 to $420. So this is like a 10 to 25% increase in the rates, and the occupancy rate is actually matching that of 2019. So this might not have mattered if there was no inflation. But with inflation eating up in all corners, especially home, rent, and food and travel, and that the wages only marginally increased, who are these deep pocket individuals and households that are booking these rooms? Adding to the concerns is that the rooms have Marriott almost doubled from that of 2019. And in the results from Marriott, nothing from the executives point to a slowdown. So, considering the Marriott results, Airbnb results are acceptable, and the numbers are pointing to a great growth outlook. So, should you rush to buy a home or do Airbnb this year? Let's wait. We're not there yet. Let's read and understand some more numbers. So, you may be wondering why the markets declined in 2022, and are we really in a bull market? This may be a big difference from my earlier videos where I'm indicating that the data is pointing towards a big recession. Let's try to read more data points. The next is to validate the rental markets. So I have taken the New York as a sample, and this is similar across major cities worldwide. The rent increases for this year is about 7 to 10%. So, considering the rent from 2019, the increase in rents is between 25 to 50% across all major cities. Let's understand the travel statistics. So, as per TSA checkpoints, the number of passengers have increased from 2021 and 2022 and almost matching the pre COVID days. Let's take a look at the travel prices. And yes, they are increasing on a monthly basis. But our CPI data is telling us that the inflation is managed well. Only data that may be telling that there could be a recession is that the travel to Canada, Europe, Asia, and Australia have decreased. Now, this is contrasting to the TSA numbers. So, who is telling the truth here? Is the government across all agencies telling incorrect numbers? We don't know. We will have to wait and see. Now, let's take a look at the Bank of America data. So, it looks like the household savings and checking balances have increased by double from that of 2019. So, this is a great news. But there is a drastic drop in credit card and debit card spending in the last year. And the curve is only going down. So now this is the contrasting data, right? If the savings have doubled, then why should the spending go down as compared to 2019? Now, next one is biggest spending drops are in the clothing, home improvements, luxury fashion, and furniture. Then we look at the unemployment data. This is increasing in the wage bracket of high income households, especially above the $125,000 annual income. This is alarming. Though savings have doubled, after tax wages have gone down even less than that in 2019. But if we look at Marriott's average daily rates, they have increased by 10 to 25%, and it's the same for home rents. So, as per 2022 household income data, 75% make less than 129,000 US dollars. So, 75% of Americans have already become poorer than what they were in 2019. In this situation, Marriott has doubled the number of rooms availability, and the average daily rate has increased by 10 to 25%. And so, something does not sum up. If things are not breaking down yet, it should break down soon. 1 month change in discretionary item spending has drastically dropped in the high income group. That is, the smart consumers have cut down their spending habits. Now it's just a matter of time before it trickles down to all set of income groups. Let's look at the house payment to income ratio chart. Housing crash will happen, but maybe in 2025, and the prices could be as low as what we saw in 2008 and 2009. So if you are expecting a crash in 2023, it may or may not happen. This is because of the data from the earnings of Airbnb and Marriott and the forward guidances. We have a problem with spending habits from almost all income groups, and the pressure is more in the higher income group. We have the data indicating that the majority of the household has gone poorer as compared to 2019. With the rents higher, spending lower, it's just a matter of time before we hit a sharp break and a crash with or without Fed increasing the interest rates. Already, big companies have cut down the employees, and they will be forced to cut more in order to boost the operational results. Recession is the only way out, but can be delayed. So far, the delay has been due to Ukraine-Russia war, and maybe there will be China-Taiwan war. Banking failures. 3 regional banks have collapsed since March this year. SVB, Signature Bank, and First Republic. Climate changes. This is the biggest reason for natural gas price drops, which was also the biggest reason for bringing down the inflation this year. Let's see how long the recession can be delayed. Majority of Americans have become poorer than 2019, and the inflation is eating away the savings during the COVID. Thanks for watching the video till this point, and if you have not done so, please smash that like and subscribe button and keep up to date with the videos I share. I will see you soon with my next video. Have a great day.